If you're a homeowner, a builder, an investor, or a business owner here in Acadiana and you want to know nothing but the facts about the Acadiana real estate market, well, you're going to want to check out this podcast. We have Bill Bacque, who gives us his 40-year perspective of the real estate market, where we've been, where we are now, and his predictions on where we're going in 2023. You're going to want to make sure that you stay all the way to the end because we had an incredible conversation. Let's dive right into it. So Bill, I'm honored to have you back at our show. Thank you so much for taking time out to be here. And I'm just super excited about 2022 numbers as far as the change, because we've seen a big impact on our market. And, although it could be painful in some places as far as sales, our volume and our sales prices are still high, but just it's interesting that we now can talk about what's going on and what has happened. So super excited to have you. I'm honored and grateful as always. Thank you for being here.
Well, I appreciate that, Jim. It's always a pleasure to be here, especially for some older retired person like me. Having a place to go is very important to me, and having the commitment to do it annually on a minimum, keeps me motivated. So it's real good to be here.
Well, it's most markets probably don't have somebody like you that they can turn to really dive into the numbers as we do here in Lafayette. So, I know a lot of people don't have a market scope. I work with lots of agents across the country, and we're so lucky to have somebody who has been here over 40 years, and you have 40 years of data that I'm looking forward to seeing, the buying patterns and the certain, the same things that happen over the 40-year period. So I'm super excited to have you.
Well, I appreciate that. One of the things that I think we can all agree on is in the residential real estate marketplace, there are certain factors that influence a market that are totally local. And for years and years, we'd remark about how Lafayette seemed to operate differently from other areas or other trends that were happening in real estate. And a lot of that was a reflection of the economy, how strong our local economy is, because real estate markets, because real estate's not mobile, it's not a product that you can move, tends to be tied to what's happening in the economy locally. But this past year, I think all of the United States experienced the impact that national events can have on any market, and that has been primarily through interest rates.
Right.
And we saw nationally interest rates basically go up. I've got a little quote here. According to Freddie Mac, we've never before experienced the doubling of mortgage rates in a single year. And we, in fact, until last year, where we saw interest rates go from just below 3% to basically almost 7% within a year. That impact has been substantial, and it's been substantial throughout the country. And it's not only in real estate. We've seen the equity markets, the stock markets that have been impacted by that. And so I think what happens is our perceptions of what reality is not always what reality is. And if market scope, what we do is one of the benefits, I believe, is to put reality to what we perceive. So there may be a lot of people out there that think, for example, well, my goodness gracious, just a year ago, we had buyers, multiple buyers buying property, making offers that were above list price, was a very common thing. No appraisals and all kinds of goodies to motivate sellers to sell. And the perception is that we are now 360 degrees going full circle, and it's actually the opposite now. And that is true to a certain amount. But one of the things that the reality does is put us in a position of at least understanding exactly what's going on and how that impacted us in 2022 in Lafayette or in Acadiana is that the sales were impacted negatively. We had a decline overall in sales throughout Acadiana of about 13.5%, 13.6%. That translates into about just under 1,000 transactions less this year than we did last year.
Right.
Okay. So there was an impact, no question about it. But the dollar volume of those sales only fell by about 7.5%.
Right.
And so what that told us, or what that basically means, is that the average sales price of a property was not impacted as much as the amount of transactions were. And that's a reflection of a lingering problem that was exacerbated in 2020 and 2021 when the market went crazy. We didn't have a lot of inventory on the market, and we ended up having less during those robust years. And so what the market has left us coming into 2023 is with values pretty much, although they did move somewhat, pretty much staying in the upper ends of where we would have expected values could be. And I think that's a pretty positive thing to be moving into 2023 under. I don't see interest rates dramatically falling, although there are some people that are prognosticating that there may be some softening of interest rates coming into the first quarter, second quarter of 2023. But even if interest rates stay the same, looking forward, going forward into 2023, there is, because of the lack of inventory, even if we continue to have a dip in demand, I feel fairly strongly that we're not going to see any kind of repeat of what we saw, for example, in the Great Recession of 2006, where we did see prices negatively impacted over 3-4 year period of time. And certainly we're not going to be seeing anything like we saw in the late 70s and 80s, where we had a tremendous amount of product come on the market because of the economic conditions in our area. So I am reasonably upbeat about our real estate market next year. I think we've come through a lot, and we've done it fairly well.
Well, there's so much to unpack there. So basically, we're going to take everything you just said, dive into it, and look back on the 40 years to see what parallels we can identify and what happened in the past and what we expect moving forward. But there's just so much to get into. So let's roll up our sleeves. Let's dive right into it.
Right.
And tell us what you got. I've got notes here. I'm going to take some notes, and we're going to just go through this. And
well, I do want to draw one more contrast. While the Acadiana overall market fell by about 13.5% in numbers of sales, the Lafayette market fell 16.2%. So the impact of the tightening of money and restrictions that were purposely done by the Fed to try to slow growth, primarily starting in the real estate business first, but to slow our economy, it impacted Lafayette Parish to a greater degree than it did outside of Acadiana. And that may be something to unpack also. What were the reasons for sales outside of Lafayette Parish to perform better than sales outside or in Lafayette Parish? Overall, those outside of Lafayette Parish declined about 8.5% to Lafayette's parish's decline of 16.2, so about half the rate.
And so I had some notes about that. So, one variable though is, it's also a different average price or median price in the outside. So is that the impact? Is it that, the supply is just so much lower than, the Lafayette area, in the, 300 and under, so that, obviously prices are less in the outlying parishes, which would tell me, well, there's going to be more demand because the prices are about $40,000 less on average.
You hit the nail on the head. Yeah. I think one of the things that we look at when we look at what the growth of what's happening outside of Lafayette Parish versus what's happening in Lafayette Parish has to be a function of price. And one way we can look at that, one factor that stands out is new construction. And I've got some interesting figures here. In 2022, there were 289 reported new construction sales outside of Lafayette Parish. In 2021, there were 206 reported sales. So what we saw in 2022 in a market where sales were declining overall, is we actually saw a 40% increase in the number of new construction sales outside of Lafayette Parish. In 2022, in Lafayette Parish, there were about 1,056 new construction sales reported. In 2021, there were 1,163 new construction sales. So in Lafayette Parish, we saw new construction sales decline 10.3% overall, and we saw them up 40% overall outside of Lafayette. So that now when we're looking at market share, about 21.5% of all new construction in 2022 was outside of Lafayette Parish. Just in 2020, the year before, it was only 15%. So we've seen significant amount of growth, and in the next slide, you basically see the breakdown of where that new construction growth is focused primarily, and you can see Vermilion Parish with 139 new construction sales, totaling about 36 million. And you talked about average sales price. So the average sales price there is 261, 259.9 is median. You go, the second in line is Acadiana Parish with 64 new construction sales, a little over 15 million. St. Landry, 49, a little over, almost 11 million. And then we have the lower number amounts, 22 in St. Martin, 12 in Iberia. And interestingly, those two parishes saw the most decline of the outlying parishes. And I think it's because of their lack of new construction that's boosting the market there. So I think that's one of the things that we've experienced, and as a real estate professional, it is something that we need to be aware of in counseling our clients who are looking for potential economic savings. One aspect is going a little bit further out of Lafayette Parish, and there you'll find it.
Yeah, and so let's break this down a little bit. So Vermilion Parish, and this is just a question. 139 sales, and I was having a conversation with somebody the other day about this, and I'm wondering how much, as Vermilion Parish or Maurice area and Milton, they had a moratorium on some construction there for a few years. And I know for a fact the developers had plans to develop, and they couldn't because of the infrastructure, the water, and I think the sewer had something to do with that as well. So I'm wondering how much in Vermilion Parish was just built up supply that couldn't come onto the market in 2020, 2021. And then, they were, started once that moratorium was lifted, which I think was at the end of 2021. Then those properties, D.R. Horton, DSLD, and some other builders, ended up, bringing those properties to market, which gave us more supply in this price range too. In the $260,000 price range, the average price range, I mean, we have way more demand than we do supply. So that makes a lot of sense to me. And then, you would think if it was just price, you would think, okay, well, Iberia Parish should have seen a greater increase in the number of sales. But it's also, I believe Vermilion Parish is seen to be more attractive to the new construction, to the builders than New Iberia.
Well, and I think there are some factors that drain over to the consumer. For example, Vermilion Parish school, their school scores. Performance has been significantly higher than any of the other Acadiana parishes, including Lafayette. And so for people who are looking to establish family units, the attraction of living outside of Lafayette Parish is certainly in Vermilion, that could be a strong factor. But price is definitely going to be a factor, and Iberia is kind of an I don't want to say it's an anomaly, but when you look at the total amount of sales, not just new construction sales, but total amount of sales for the parishes, both Iberia and St. Martin parishes were the lowest performing parishes that we have. So overall, there are some demand problems or challenges in those two parishes.
And in this case, we're talking about new construction, which I was just talking to a contractor a second ago, and she was mentioning how that the cost has increased greater than the increase in the average price. For instance, if we've had an increase in the last few years, we did have a 10% increase approximately in the average sales price. But for new construction, the increase was closer to 20% is what I'm hearing from the contractors, 25%. So their margins are getting cut shorter, but their average price has certainly increased. But so when you look at this, New Iberia, if the average sales price for new construction is $214, it's very difficult to develop and build a property and sell it for $214. So this is definitely a supply issue as well. You can't do that consistently unless you're a big tract builder and you've got your other ways to bring in income versus title companies, mortgage companies, so that they can discount that price even less than other builders can. But so I think that's interesting. I mean, we definitely know that new construction, which it is doing way better than it was in 2018 and 19 when we saw declining since 2014, I believe, in the numbers and sales of new construction. Some of this too is going to be interesting how this is going to impact 2023 when we know the perception. We were talking about the perception and then actual fact, which we're gonna get to the facts this time. But there's builders out there that are hesitating and nervous because they don't have that crystal ball. They don't have this information. They're worrying about where should they be building. If they start a build today, what's it going to be like in 6 months?
Absolutely.
And
you always have to consider that new construction, it always sets the high bar on price because it's brand new. Okay, so you're paying for new things.
Right.
So typically, all things being equal, an existing home is going to sell for less, equal in all aspects, going to sell for less than a new construction home because the new construction home has the latest pricing built into it. That being said, new construction is going to become more and more critical in the short term for how do we deal with the shortage of inventory, because part of that low inventory aspect is the sellers themselves being challenged by interest rates as to what are they going to do relative to trading up. And so my point there is that roughly, depending upon which expert you listen to, anywhere between 75 and 80% of the existing homeowners today who have a mortgage on their property have a mortgage rate that's less than 4%.
Right.
Okay. Now, how do you get in a marketplace that is not producing the majority of inventory by new construction? Then you have to get that inventory from existing housing stock. Mm-hmm. How do you get someone who's sitting on let's say a $250,000 home with a $200,000 3% mortgage to trade in that $200,000 on, let's say, a 6.5% mortgage and trade up to a higher priced property? How do we motivate them to do that? And that's going to be challenging. So the question becomes in 2023, how many homeowners are going to be imprisoned in their existing mortgaged home that do want to move up, but can't find an economic way to do that? And how are we as real estate professionals, how are we going to address that in dialogue with our sellers? And part of that is we're going to have to be able to sharpen our pencils really good to come up with a number that is an equity number, and then try to use that equity number in the marketplace with the blending in of new interest rates to see if that number will work. Yeah. And it's not going to work for every seller, but we're going to have to be able to show them how to do that.
So, I mean, what you just said is, making sure that we're powering that move from the equity that they have. So that's enough to make that happen. But also, right, that's what you're saying? Like, utilizing, you've got to have that in order to move up to that certain price range. You got to assume, prices have gone up, interest rates have gone up,
right?
Consumer price index has increased. You have to. There's two different, major variables. First is hopefully your house, as it is right now, we can see a lot more equity than we had in 2019.
Absolutely.
If you bought a house, so you have that those funds there. And if you bought a house in 2015, it's even, it's not significantly more, but you've got more equity than you ever had. So power that move with the equity. Or the other part is, what was going through my mind is that you got to have a job that's increasing pay.
Right.
And hopefully, what will eventually happen, and we see it, over time, every single time we've had inflation and we've had, how I joked with my wife's grandfather for a while because he was like, I can't believe kids are paying $500 for rent, in Lafayette. And there's an app you can take a.
Not many are.
Yeah, I put in the app. I said, okay, what is $500 back in 1926 when he was like he passed away recently, but it was like the same exact price that he was paying. So yeah, we're paying $500 for one room, for kids to go to school. But when you factor in inflation, I mean, that's what happens. Everything goes up. Costs, and that's going to happen naturally no matter what. We just had an accelerated increase in the inflation. So, what's going to power the next moves is going to be their equity, and hopefully their jobs and their finances go up with inflation. And it may take a few, we're going to have ups and downs, but eventually that's going to work its way out of the economy. So, I think it's a good point that a lot of people, I read a statistic recently, there's more homeowners have more equity than ever before, which makes it, this time around a big difference from in 2008.
Absolutely.
When people were upside down. And I hear it almost every single day, Bill. People are saying, well, Jim, I want to get on your foreclosure list because there's going to be a bunch of foreclosures. Well, that's just not the case. That's not fact. That's the perception that's out there. But, when they asked me that, I said, well, yeah, I can do that. And there will be foreclosures, but it's going to be the same reasons that we had them last year. People are going to lose their jobs. They're going to get divorced. Things are going to change. That's the only reason we're seeing those foreclosures. It's not because people don't have the equity and they can't sell their house.
Absolutely.
So I think that's a interesting point this time around is different. People can afford their houses as long as they have a job. And I don't know if you've been driving around Lafayette, but it seems like it's busy and everybody's working. And I know just nationally we have, the lowest unemployment we've seen in quite some time, and so like I think that as long as people continue to have jobs, which I think goes all the way back to interest rates, which I'm very concerned about as interest rates rise, the businesses out there that have the lines of credit that are keeping them going, I'm hoping that, that keeps going because, everything can fall just like in 1985 when everybody lost their jobs and left town. Right. And so let's check this out because I think this is one of my favorite, charts that you guys do because you go back to all the way back to the 1980s, early 1980s, and you can see the impact of the oil crash in 1985 that it had on our market. So
yeah, you can. Now, one thing that's also interesting is we were dealing with a lot less numbers back then. So, you can see annual sales were maybe even at their height, which was 1985. That was when prices had dropped so low, it spurred sales growth. But we're talking about less than 2,000 sales, 1,896. And last year in 2021, we had 7,300 transactions. So just thinking in terms of a 40-year period or perspective, how much we've grown in that 40-year period of time as far as the numbers of transactions is an indication of what Lafayette Parish has done over the last 40 years, the growth that we've had.
Right.
But you're right. When you have these small amounts of dollars of transactions or numbers, looking at it visually, you don't see or it doesn't perceive to be quite the same kind of drop that you see from 20 to 21, at the top of the heap.
Yep.
Okay, and in fact, what we were seeing back then, as far as movements percentage-wise, were greater. As you can see, we've had double-digit. We've had significant movements in the marketplace over time. So this is nothing really new. And one of the things we were talking off camera, you really see it in the 2008 recession, the Great Recession, where we saw the market decline and then it kind of stabilizes for 3 to 4 years. Doesn't continue to plunge, but just kind of stabilize. And then you see the growth that we had basically from 2012 all the way up for the 10 years through to 2022. So my point is, I think there is some basis for us to think in terms of 2023, 24, maybe even 25 as being years where there's not radical growth or radical decline, but a certain stabilization. Sure. And then we see, hopefully after that, a move up again. A lot of that this time around is going to be based on national factors that are beyond our control. That was the same thing that occurred in the 2008 Great Recession. It wasn't really local factors that were causing it. When you go back to mid-'80s, it was local factors more than anything else.
Sure.
And so when you had a lessening of demand in the '80s, it was accompanied by a corresponding increase in the amount of inventory. Here we've had a lessening of demand caused by the cost of ownership going up, but we have not seen a corresponding increase in the amount of inventory. Even though the numbers of listings have risen, they haven't risen in relationship to the demand.
That's right. So in essence, in summary, and we're going to get to that though, is although our demand is falling, so too is our supply. We're not listing. The amount of houses that we're listing are less than what our demand is falling at this basically the same rate. So we're not increasing the supply as much as we should.
As a general statement, that's correct. But again, one of the things about statistics is they can be as misleading as they are leading. And so when we get into the discussion a little bit further along the line, we can look at price points and see that in certain price points, the amount of deficiency in inventory is much more pronounced than in other price points. And so I do think that's going to be another key in 2023
average sales price right here.
is watching what's going on with not just average sales price, but the amount of velocity of sales in certain price points. Because if I have a seller and I have a listing that's at $250,000 and there is a 1.5 month supply product on the market relative to demand, I have a different set of circumstances than I would have if I have a seller who's got a $350,000 home and there might be a 5-month supply of product on the market. And so we're in the same marketplace, but the impact of that marketplace is different based on the price of the product. We need to know that, and we need to be advising our sellers of that on a regular basis, because as you know, that's not a static number. The number of months supply of product can change from month to month. And where we might, when we list it, have been in a strategically strong position relative to competition, and we put it on the market, and the next month 5 new listings come on the market. Now suddenly our balance in the marketplace, competitiveness might change. So it's something that you as a real estate professional need to keep up with, and as a consumer of real estate, the general public needs to know from people who know.
Right. The general statements of where you get in trouble, like, hey, we have low inventory. Well, that may not be the case if you're talking to somebody who's got a $900,000 house
Exactly.
in a certain neighborhood, because it's really all about, like, the local neighborhood can really impact what is going on in the supply and demand, because price is a function of supply and demand. If you have too much supply, prices are going to be lower. If you don't have enough supply and more demand, then it's going to be higher. So it's pretty simple, but it's very complicated. There's lots of variables that will affect that. So, like in this case, you've got we're showing here the 40-year average sales price of homes reported sale on the MLS. So you can see in 1985, when we had this huge increase in supply, which is on the next was on this slide. So 1985, we had almost 7,000, almost 8,000 homes hit the market. And, that's close to where we were in 2019.
There's only been 1 year that we have actually exceeded that number in 40 years.
That's insane. So, like, the impact of that many properties hitting the market back then was tremendous. So you could see that on the next slide. It didn't happen overnight, but the prices and the average value went down for, what is that, 3 years?
Absolutely.
So
Absolutely.
3 years, and then it started working its way up, which I think is...
And you can see from the new listing graph that subsequently for, 1, 2, 3, 4, 5, 6, 7, 8, almost a decade, okay, you had, as far as new listings coming on the market, you had a relative low amount of new listings coming on the market.
They hit the market, and then,
because there was such amount of inventory left over, that the market just
couldn't absorb it.
And so we set up over that 10-year period for ultimately what would happen in the average sales price growth, which when you go back, you can see in the 2000s, we had a nice steady growth of average sales price. And part of that was the balance that we had of inventory to demand. Good, steady growth. Now you compare that average sales price going into the 2008 recession, you can see we had a slight drop in the amount of average sales price, and then that set us up for the next stage of growth, which was strong, and we were actually in kind of that level period of time going into the pandemic, and then everything went crazy.
That's right.
Okay, everything went crazy. And what we've been saying, but it's so hard to do, what we were saying during those 2021, 2020 was, hey, these years are crazy because of what's going on here. Mm-hmm. The government's putting trillions of dollars and money into people's pockets. The Fed is lowering interest rates to zero, basically, and setting up the stage to ultimately see this phenomenal growth. But we all said these are anomalies.
Sure.
These are anomalies. We shouldn't pay attention to them. But we operated for 2 years based on the income that it generated. Mm-hmm. And now we're going to have to look at maybe some correction. I'm not here to talk about doom and gloom, because most of what we've been talking about is relatively positive. But we are going to have, in my view, some correction that is going to occur in 2023 and possibly into 2024. We'll just have to see.
Well, and we saw some correction in 2022 already.
We absolutely did.
And the correction was much larger. Like overall, the year was not as bad as it could have been as far as sales. Values actually have gone up,
right, because
of the supply. But we did see a correction, and we're expecting more of a correction. But it looks like we're going to be in line. And I know you talked about this. We were on a good pathway from 2014, through 19. It was a relatively actually low growth, but it was stable. And then we had 2020, 2021, 2022, which is an anomaly. But I mean, that was about a 30% increase in property values from 2018 to 2022.
Right.
And now, if you look at, 2022 back to 2019, that's still, we're looking at, a significant 9.7%, each year. And if you look at the last 3 decades, from 1990 to 2000 and 2000 to 2010, and then 2010 to 2020, the average was 5.6%
right.
in those decades, and that's more in line with what we would probably see moving forward. So,
wealth is created if you can get a 4% compounded rate of ownership, okay, on your total asset, your house, over long periods of time, you create and generate an enormous amount of wealth. And part of that is the beauty of leveraging through mortgage financing. Mm-hmm. And that is, if I have a $300,000 house, I don't have, if I have a mortgage on it, I don't have $300,000 in it. So let's say I have an 80% mortgage on a $300,000 home. Mm-hmm. That means I've got $60,000. Well, if my $300,000 home goes up 5%, okay, that's a $15,000 increase on the $300,000. But I don't have $300,000 in it.
Right.
I got $60,000 in it. So what's my return on $15,000 on $60,000? Okay, that's the beauty of leverage. It's always been there.
That's
so
about
a 3 to 4% or a 5% increase in overall asset value makes millionaires out of the people who are leveraged.
And that's why people buy houses.
That's why
you should buy a house and not rent, because you're talking about a 25% increase in your cash on cash return, in essence, once you sell that property or refinance it and buy another one. Which brings another point. We talked about, interest rates. I am having different conversations this year that I've never had before, and a lot of people are starting to consider, well, wait a second, I've got a $350,000, $400,000 house, and I need to upgrade because we just had another kid or whatever, and now I'm thinking about, well, I've got a 2.75% interest rate on this property. It's increased $30,000 in the last 3 years. If I sell it, I'm going to lose that interest rate. So some people are saying, we're really encouraging people to keep it. If you can keep your house and rent it out, and because your mortgage is so low, you rent it out, the tenant pays your utilities and maintenance. Now you have a piece of property that is going to increase in value, and somebody else is paying for it. You're not even putting your money towards it. So it's going to be interesting to see how they're going to make that jump without that equity to power it. And it's going to be, to keep that interest rate, they're not going to refinance. They're going to have to either take money out of the market or, get in their savings to buy that next property.
Right. Or live in their house for 30 years. And how many people do that? So I think those are all, discussions that have to go on. They should be discussions that are driven by information. And that's what this is all about. And the message, again, to the real estate professional community this year is, hey, you may have been able to have your best last 2 years in the real estate brokerage business because of just the marketplace. Okay. Now your ability to have professional advice and give professional advice is going to be much more meaningful because it's a different marketplace and the factors are going to be different. And we have to be able to weigh, is this something, should I not sell my house and turn it into a rental? Should I sell my house, take my leverage, take my equity, and lose the advantage that I have in interest rate? You have to run the numbers. Okay, it's not a one answer that you can one off on everybody. Yeah. It's going to be different for seller A, seller B, seller C, and we're going to have to be able to customize our advice to the needs of our client.
No doubt, and it's custom to every neighborhood.
Absolutely,
the facts are different in every location, every market, and knowing how to navigate that and having somebody that knows the market is going to be more and more important than it was in the last few years. Now, this is the days on market. We're in 2022, you're showing that, our average days actually for Lafayette Parish decreased,
right?
To 30 days. And you've got the list price to sales price. That's been constant for quite some time.
Several years.
You don't see
again, that's all an indication of that tight market. Relative, even with a lowering of demand, the market's still tight, reasonably tight as far as inventory is concerned.
But we're seeing, in 2022, the average days on the market for all parishes were, I guess that's 37, and it was 46 in 2021, and for Lafayette Parish 30 and 35. But we have seen an increase in December, like November. We towards the end of the year we started seeing a little bit of an increase in days on market, just month to month.
A lot of that's seasonal, though,
right?
Because the fall typically is not a robust time of year, typically for housing activity. Although there has been in the last 2 years a little upbeat in December, I get that, but as a general rule, spring and summer are the high months for sales, and it somewhat tapers off. And so when you get that tapering off in the winter months, sometimes your days on market will go up slightly.
What do you think, going back to, we had, this was in 1985, the average sales price kind of dropped because the oil industry, disappeared overnight in that, that period of time. And now we know that the oil industry, what do you think is going to be the impact to the real estate market in our area in relation to the oil industry?
Well, interestingly, one of the local papers, I believe the Advocate, recently had an economic summit here in Lafayette and brought some various industry leaders in to give input as to what they expect from our economy. That included Dr. Gary Wagner from UL, who is kind of our Acadiana Lauren Scott, if you will, on overall economy. And one of the things he brought out is that the oil and gas industry has consistently been declining as far as its contribution to our overall economy. Back in the 1980s, one of the statements I'd make quite often is, I don't know whether or not we have a 6-cylinder or an 8-cylinder engine, economic engine in Lafayette, but whatever it is, the oil industry was either 4 or 6 of those 8 cylinders.
Sure.
Okay, it was a major part. I think today, Dr. Wagner was citing that the oil industry might make up 15% of our overall economy today. That now the big drivers of our economy are the medical industry, medical service industry, technology. It's a whole different environment that we're involved in as far as Lafayette is concerned economically today than when it was in the mid-1980s. So I don't see ourselves as being singularly vulnerable to one particular industry. I'm reasonably positive about Lafayette as long as there's nothing catastrophic that happens over to the overall national economy. I think we're in good shape. I still believe this is God's country, be it God's oil country or God's medical country.
Sure.
This is still the place to be.
Right. Well, and let's talk about growth. So you got this chart shows the growth outside of Lafayette Parish. We talked about this earlier. We saw, lots of growth in the outlying parishes, and with the 32% to 35%, change in the last year or so, that's not a huge difference.
No, but it is progressive.
It's progressive. But one of the statements you said here is, by 2022, sales outside of Lafayette Parish have grown by 108% over 2010's level. I'm curious, do you expect us 10 years from now to be saying the same thing? We had 100% growth?
I'm not going to put a number on it, but do I see this trend continuing? And the answer is yes. A couple of reasons why. Number one is price. Okay.
Right.
We've talked about that already, that the cost of land in Lafayette, the cost of development in Lafayette, the cost of materials in Lafayette, the cost of labor in Lafayette, all of those are impacting on pricing in the Lafayette Parish and may be to a lesser degree impacting properties outside of Lafayette Parish. So I do see that. We do have to remember that Lafayette geographically is one of the smallest parishes of the 64 parishes we have in Louisiana. It's a relatively small parish, and surrounded by some fairly large parishes. So I do believe, just from a physical standpoint, the idea that as the population grows, that you're going to have to exceed ultimately the physical boundaries of Lafayette for any number of reasons. One could be price. The other, it could be, again, new construction. Well, one other factor for new construction is even in Lafayette Parish, in order to find new construction, you're having to go further and further to the periphery of the parish. So you're almost to another parish anyway to get new construction in Lafayette. If I can save $50,000 in making that leap just maybe a couple of miles, is it worthwhile? And the answer is maybe.
Well, we're seeing it in the numbers. It seems like,
we're seeing
for
it
sure,
in the
it's
numbers. We're seeing it in the numbers.
you know, it's driving the demand. Is got to be a big reason for that.
I would think so. I would think so. I would. That's just kind of showing you the sales
Right.
performance in those outlying parishes.
And again, my comment is, I mean, it's got to be a big factor of that's got to be the average sales price.
And I'm going to point out, there's two that have the highest annual decline are Iberia Parish with 19.5% decline in numbers, and St. Martin Parish with a 19.7. Both of those were the lowest for new construction of any of the outlying parishes, if you will remember when we
Sure.
talked about that. So there is some correlation there. We kind of touched on that.
Yeah,
We
price.
Going to Lafayette Parish now, and
Yeah, so Lafayette Parish, we had a decrease of 10.3% in the,
that's in new construction.
In new construction, and I wrote down, obviously the price is more in Lafayette Parish, but also another variable that's pushing that cost to the builders is the codes are stricter. They have more. The planning and zoning, they have to jump through more hoops. And today I was talking with a builder, and they're telling me that now, like, they're having to provide the systems are costing them more because they've got to meet certain requirements as far as like energy efficient and whatnot. So that's creating a higher price, which is, driving other people to buy the same house, maybe outside of Lafayette.
Perhaps, although I would think that if they're having to see increased cost in like HVAC because of environmental requirements, those environmental requirements are coming from the federal government. So the chances are you're going to have that same kind of HVAC system if you're in another parish also. So I'm not sure that is the cost variant, but there is no question that building codes, things such as that, can vary from parish to parish.
And if I'm a builder, I've seen price of wood go down, but all the other things are still high. I've heard that labor's the same. About it was, it hasn't changed as much. Wood actually has come down. So then I'm wondering, like,
Land cost.
That's
a big differential. You might, not uncommon to see $20,000 to $25,000 an acre being paid being paid in Lafayette Parish for developable land, as opposed to maybe $10,000 to $12,000 somewhere else.
Right.
That makes a difference. And it shows up in the numbers.
And what I'm hearing, and from builders, is it's really the systems, and it's not the bells and whistles. They're still spending a lot of builders are spending $220 a square foot just for the house without the land and everything else, and that's with very healthy allowances for the bells and whistles. But they're talking just the systems in the house, the house itself, not the granite or the thing. It's the doors, it's the windows, it's the electrical systems, the plumbing systems. All of that has increased the price for the builders, but not so much the labor. I've been told, and this could be wrong, but the labor isn't what's driving the higher costs. It's more so the cost of the materials for the actual house, not the granite, not the painting or anything. It's mostly the materials for the systems. But I thought that was very interesting to look at. And then this goes right into the hot areas of outside of Lafayette Parish is obviously Vermilion, and we talked about that. We know D.R. Horton and DSLD are building. They're some of the largest builders in the country, building in those markets.
That's correct.
And they're building in that price range, and that is where all the demand is. $300,000 and under. Right.
There has been, and we can see that a little later when we get into price breakdowns. that with the lowering of interest rates that we've enjoyed over the last couple of years, there's no question there's been somewhat of a migration for those people that might of pre-pandemic been looking to buy maybe a $275,000 house with all the incentives, interest rate wise and all of that. They were bumped up into the 300, maybe 325. So we saw, and we'll see, we saw it even in 2022 in a market that was adjusting. We saw an increase in that 300 and above price quadrant, while the under 300 and the under 150 both dropped. We can look at that a little later on, and that's kind of an indicator that we as consumers were taking advantage of that low interest rate environment and buying the most property that we could, and that now that's going to be somewhat curtailed. I think our inner wants in housing are still going to drive us to say, well, gee, I sure would like to have this or this or this. And people are probably going to maximize whatever they can borrow to get the maximum home that they want. But the reality is we won't have those lower interest rate environments that would allow that to happen. So I think you're going to see some migration back to those lower levels simply by people who at lower interest rates could have qualified for more, but now they're not going to be able to.
So knowing what you know, and based on this information, you're a builder here in Acadiana. What do you say to somebody who's, they have to continuously build new properties? Should they be looking at more in the outskirts of town, or should they be looking at inside? And what would you say about starting construction on a few spec houses today?
Well, I've never had the courage that builders have.
Yes.
Spec builders. I'll confess that at the beginning. But I think what I would tell a builder is don't journey into areas that you're not competent in. Okay? That is, if you're going to compete in this marketplace, compete where you can compete the best. So if you're a stick builder who builds 3 to 5 homes a year, I would generally say don't be going in and competing against a DSLD or a D.R. Horton, because you're going to lose more times than you're not if you're building in that price point.
That's right. Okay?
So a lot of the and this doesn't mean that D.R. Horton and or DSLD are not quality builders, but the quality small builder in Lafayette is moving up in price points, and we're seeing more of them building in that 300 and above, which is a price point that DSLD and D.R. Horton kind of stay away from. It's not their bread and butter. They will build in it.
That's right.
The problem or the challenge for the stick builder, the small builder, is how many others are going to be, doing the same thing. If I'm going to build $200,000-$300,000 houses, hey, the market, if I'm good at it, the market will probably embrace me. But if there are 10 other builders who are having the same exact idea, now all of a sudden what's coming on the market is not 2 new properties, it's 20 new properties.
Right.
Okay, and that's the thing that builders, you cannot be aware of what's going to happen with your competition, and that's always been kind of the death knell for if you will, for builders is, good Lord, I started building this $300,000 house. There were only 2 houses on the market, and now I'm through, and I've got 8 of them on the market, and 4 of them are in the same neighborhood.
Right.
Now all of a sudden it's a little dicey. So I do think you have to be careful at what you do. If you're doing something, if this is what you do for a living, you can't not do what you do for your living. But you're going to have to be a lot more careful.
Yeah, and strategize more about the location, the pricing, and really put the pen to the paper on prices. You know.
Absolutely.
So,
and if you won't, your banker probably will.
Right, exactly. So let's look at, speaking of that, we've got Lafayette Parish dollar volume. We know we had some stagnant years, where, we had some increases. And I remember in 2018 and 19, you coming to talk to my group. And, I was so excited because I was like, well, 2018 is the best year we've ever had on record, but it was only by a few sales. It was not a lot. And then same thing with 19. We had, as far as dollar volume, we went from 750 to 768 million, but it was still the highest that we've ever seen in Lafayette Parish until we got to 2020, which is obviously, when we 2020 when we hit COVID and
that slide kind of just jumps out at you what those 3 years 2019 2020 2020 21 22 have done. Those 3 years, 2019 was kind of the transitional year into COVID, and so what we basically have is these huge numbers that should tell us right there there's an anomaly. This is out of context.
And this is the problem with new construction, right? So like if we're saying, prices and sales are gonna be closer to where they were in 2018 and 19, and we'll probably see a similar trajectory without this anomaly year. But will the prices of the materials go back down? Because I don't believe in most cases the builders that I'm talking to, they are not increased, even though the average sales price has increased, they're not seeing that on their bottom line.
Right.
So if they, they're still, making the same amount of money with the same, with a price, a house, and some of them are even making less because a lot of the materials, they can't even get a price for an AC until that AC guy orders it. So that's a big variable. You price out a property and then you don't start for 2 or 3 months, and now you're buying units and you're buying it at the new price versus when you actually did your spreadsheets and your pro forma. So it's going to be interesting. Huh?
It is going to be interesting. And look, the whole concept behind this, higher interest rates are what's causing this potential slowdown. Okay. What's the reason for the higher interest rates? Coming from the Federal Reserve, the reason for it is that their hope is that at some point raising interest rates is going to lower cost. Because the whole purpose, supposedly, of this all happening is we've got inflation, prices going up at too high a rate. They want to tamp that down. If, in fact, their gambit works, then prices should come down. Now, maybe not across the board, but they should come down. And the real question is, how long?
Yeah, and I think they're starting, and this is just my hunch, that they're starting with the real estate industry because, when you sell a property, it's not just that property you're selling. You're the economic impact of that one sale is, I want to say, like the last thing I read was like, almost $50,000 of other purchases and everything that happened for every sale. So even though the sale prices have not come down in the real estate market, it definitely has had an impact. If we sold 1,000 less homes this year, you multiply that by $40,000, the economic impact of 1,000 less homes in general is going to
be
significant. So, because of this, the only reason the prices are where they're at is because we just have less supply. There's less sellers coming on the market right now, then because where are they going to go? They got a lower interest rate. They've refinanced it over the last 2 years. They're not moving because they're going to wait until they have that price. So that's keeping that up. But eventually it's going to normalize. Like I'm sure you've seen over the past 40 years, at some point, people are going to, and you have a great slide in here about the interest rates we'll get to, but at some point they're going to say, okay, well, this is the new reality. In 2021 and 2022, that was an anomaly, and if you were able to take advantage of it, great. But now this is the real world.
That's exactly right.
You should be comfortable with a 5.5% interest rate on your property.
And I would think the longer that we are in that environment, okay, the more people will be comfortable with it. Okay. What has caused the disruption to be so significant this past year is, remember the quote that I had from Freddie Mac, that there's never been ever a scenario where interest rates, long-term interest rates, rose over 100% in 365 days.
Right.
Okay, so it's not so much about where we are interest rate wise. It is how quickly we got there. And the longer it stabilizes, that if we can stay in this 6.5 range, 6.25, maybe even go down to 5.75, if that can all happen, and there are prognosticators that are predicting that this year at maybe the end of first quarter, end of second quarter of 2023. If that can ultimately happen, then that and it stays that way, there's going to be a certain acceptance that happens that the market will show. So
well, let's talk about the interest rates, because we are already over our time, but we're going to keep going because I could do this
forever,
for hours. But
let's do it.
Let's talk about interest rates. So one of the things about historical. This is page 45.
45.
Yeah, page 45 of your presentation.
Right.
You show it right here. You can see the trend line that you've marked over the last 30
correct.
years. We're still right about where that average was over the last since the 70s.
That's correct. So the issue is not the rate. It is how quickly we've gotten here. And to a certain degree, how the government's economic policy that has been influencing us since the Great Recession in 2008. We've been living in an environment where interest rates have been created to be historically lower than the trend line. And so it's part of that idea. For a decade, we've been living in this non-real interest rate world. And now, once we get through all the Fed tightening and all that, we're going to have to get back to what are the nominal right rates to have in a real world where the government is not printing money and the Fed is not intervening in the securities markets, buying up mortgages to keep interest rates down. Once we go through that and we're back to normal, okay, the longer we're on that normal trend, the less you'll remember about it. It's like the Great Flood of 2016, okay? How many people are worried about the Great Flood of 2016 in Lafayette now? In 2018 they were. In 2022 they're not.
Right.
Okay. So it's about distance.
Sure.
And I think as we get more distance behind us, we're going to be able to look at this market and say it's a normal market.
Well, and here's one interesting thing. We don't have a slide on this, but the Fed controls the interest rates by lowering or raising the 10-year treasury yield.
Right.
Which, then the private markets and the banks base their rate off of that. And typically, we've seen a 1.7 point spread between the 10-year treasury yield and what we typically get on a 30-year mortgage with the banks. And now we're not there. I mean, we're at a 2.7% spread. That's a 1% that is really, we're in uncharted waters. And I think it's because, the Fed's, the uncertainty, which is what banks don't like, right? I mean,
Absolutely.
But what that tells me is as time goes by, that's going to most likely come back down to a 1.7 spread somewhere right there, you would think, because we've never seen it in this for this long at such a higher spread. So there's a 1% interest rate there that really, once people stop panicking, we could potentially see the 30-year mortgage rates drop by that 1%. What do you say about that?
Well, I would agree with what you say. And the other thing, a person owns a home now, I think typical homeowner, the duration is probably somewhere around 13 years. Mm-hmm. So another dialogue we have with people is that, hey, I don't know where interest rates are going. I don't control them, and neither do you. But what we do ultimately see is that the interest rate environment is going to be what it's going to be. Mm-hmm. And that what we can look at from a historical standpoint is that the chances are within a 13-year period that you own your property, interest rates will vary enough that there could be some incentive for you to refinance. Mm-hmm. Okay, so if we're wrong, or if what not we're wrong, but if interest rates ultimately are too high and they do go down, you can ultimately take advantage of that as a homeowner through refinancing. Mm-hmm. Now, you can't refinance every year, every 1/4% or whatever, but if there's enough of savings that are ultimately ahead in the years ahead, because of interest rates declining, people can take advantage of that. Right. And that we can always advise them that. So what it becomes, and I'm going to go back to that little ditty that we talked about the last time I was here, that it's not so much about the rate that you got, mm-hmm. Date the rate, marry the house.
That's right.
Okay,
That's
look
right.
for the house you want. Okay. Yeah. Over a long period of time of ownership, it generally works itself out. Mm-hmm. Okay, either the 13 years that you're in it, on average, you create enough equity to overcome whatever is going to happen, or ultimately you refinance and you take advantage of lower interest rates. Either way.
But all the experts you're reading and hearing about right now, would it be accurate to say a lot of people are predicting the interest rates to decrease towards the end of this year, to be less than where they are today? I think that's a possibility. None of us have a crystal
I think that's
ball.
a hope. Okay, all you have to do is watch one of the financial news networks and follow the stock market every day. If they talk in terms of, the Fed might, with this lower interest rate, lower inflation number that we just got that's infinitesimally lower, oh my goodness, we're gonna get lower interest rates, right. And the stock market goes up 700 points.
Right.
The next day, if somebody says something negative, and it drops 800 points. Yeah. So there's a lot of that out there. Well, we're going to get lower interest rates. We're praying for lower interest rates. I just look at it from the standpoint of there can be any number of factors. A lowering of sale prices. Mm-hmm. If values can ultimately decline somewhat in certain price points. That can make up for an interest rate differential. Also, that could incentivize someone to say, I'm going to move up because now I see an economic advantage. I don't know what that economic advantage will be in 2023 for sure. It could be lower interest rates, it could be lower sales prices, but there will be probably in 2023 a combination of both of those in certain instances that will be working their way through. Long term.
Well, we know that the new construction is going to be less. I mean, based on what we're seeing in 6 months, we're probably going to have less new construction than we did last year.
And
based on the
and
numbers.
what's the incentive that we're going to have more listings?
That's my point. Is like you know, for people to make that decision, I'm moving up. They got to put their house on for the market, and so like we've got to see some type of movement. Either the price, the only way the prices are going to come down is if we get more supply.
Well, one thing we are seeing is in this constrained marketplace, there are a lot of people in price points where there's no inventory, and there are buyers that are out there that are waiting for something to come on the market, and if something comes on the market, they're going to jump on it.
That's right.
Okay,
That's
so in today's environment, you're going to have that. It's not a zero sum game here. That is, we're going to have a real estate market. There are going to be people buying. There are going to be people selling. It just may not be as much as last year. You may have to compete. If you want to grow your pie, you may not be able to grow the whole pie. You're going to have to grow your pie, your share of the pie, by stealing it from somebody else.
Right.
Okay, that's what's going to happen in the brokerage business. On a buy sell, hey, you got the right house. You got it marketed correctly. You got it fixed up. It shows well. It competes well. You're going to be in the play. Okay.
Right.
If you're not, if you're looking for, hey, I'm going to price it twice what it's worth because I'm just, I know there's not a lot of houses out here. Blah 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 blah. You may find yourself on the market and wondering, well, why isn't the market responding to me?
Well, we know that there's a supply issue right now, and we also know that there's a lot of baby boomers that, this tsunami you have mentioned in the past that's coming. And my parents are in that category where, they're living in a 2-story house. It's 6,000 square feet, and there's going to be in the next 10 years, there's going to be a whole lot more houses that are going to be coming up on the market. It's just how fast and when. So that's a factor of when does that happen.
Absolutely. And it's a good question. When does that happen? There is that baby boom stock of the bubble of baby boom generation people. I'm a member of that generation. Kids that were born right after World War II, from 1945 to about 1955 is the baby boom generation. Right. I was born in 1951, so I'm smack dab right there.
So speaking to that demographic, what do you say? What's going through their mind is like, okay, I've got to put my house on sale. Where am I going to go? Obviously, they want to downsize, but what would you tell somebody? A baby boomer now, if they're living in a large house and starting to think about, okay, I'm gonna have to sell this house,
right?
And I'm gonna move somewhere. Would you encourage it just to do it at any point, or would you wait, or would you do it now when prices are high? What would you say?
Well, I would generally say if you have the means to do it and the want to do it, do it. Especially for somebody my age. I mean, what you waiting for? 5 years? I'm not sure I'm going to be around in 5 years. So it's more about, hey, what are my needs right now? Yeah. And one of the things that typically happens if you've been living in a house for a long period of time, your equity position, in many cases, they don't have any debt at all. Mm-hmm. So to them, if I'm paying cash for a property, what do I care whether or not the interest rate's 6.5% or 3%?
Right.
Doesn't matter to me.
Right.
I'm not going to be paying on it.
That's
So it's more about what are your needs. And for many of them, it's not necessarily buying a house. Maybe it is moving into an assisted living type situation, selling, getting my equity out or my cash, and living off of that. Nothing wrong with that, because you know that the tax laws are set up to favor people who are individual homeowners. You don't pay on any gains while you're buying the whole time you're buying, and then when you sell, if you sell for less than $500,000 worth of gain, you get all that tax free. So for me, the silver tsunami, these older people, they're sitting on. You see that commercial that's on there right now about the person who has a life insurance policy, and you've got cash value built up in there, and there are guys down in the mine and saying, "Hey, you've got cash value in your life insurance," and the people up there, the old ones, they, "I can't hear you." Okay, well, it's the same in your house. You got a retirement account in your house,
right,
okay, that's tax free, different from other retirement accounts that you got to pay taxes as you take it out. This one, you don't pay taxes when you take it out. So there are things that are going to happen down the road that are going to help to balance out this inventory imbalance. It just won't show up in 2023.
Well, I wanted to talk about a couple more things. We're running out of time, but I want to hit on anything else we haven't hit on, and then I want to talk about rental and then commercial.
Well, one thing that you can, and you look at page 26, because we've talked about this before. This is in Lafayette Parish. This is the distribution of sales.
Yes.
Okay, and we've talked about that several times about. The impact in the marketplace is not the same, even when we talk in generality, hey, the market's down 16%. Well, where is it down? And as you can see, this little graph, the blue line is 2022, red one's 2021. So we lost sales below 150,000. We lost sales between 150 and 299. The only area in Lafayette Parish where we had positive growth in 2022 is 300,000 and up. And
which my notes here, I mean, that's a supply issue, right? I mean, we know there's plenty of demand in under 300,000, but we don't have enough supply. So I would think that would be why we're seeing
it's
less
part of
sales.
I think the interest rates are the other part of it.
Interest rates.
We can lower interest rates, kind of incentivize people to buy as much as they can. And even in 2022, when we saw interest rates climbing up, there was an incentive there to lock in at this point instead of this point. Okay.
And we saw
and that really went up until about June. I mean, June is when it really kind of started getting really crazy on the interest rates, and that's when we saw the impact come down.
No doubt. Now, what do you think about? So before we end, I've got two more questions. And I hear about this all the time. We have a property management company, and we're doing very well. Our occupancy is very high across the board. If you're an investor and you have if you have properties, so the rental market is strong, the demand is strong. Now we've had a huge increase in supply in rental. I mean, we went from last year about the same time, we probably had 20 houses on the MLS for rent. Not all rentals, probably have 50% of rentals might be listed, but now we have over 70. But there's still, out of all the properties that we still have a very high occupancy, and we've increased the rents, with the consumer price index. So what do you think's going on? And you've been hearing this. I know you hear it too. People say, Bill, where's everybody coming from? They got all these apartment complexes, and they've been saying that for 10 years. Every time there's a new apartment complex, people say, where are all these people coming? I don't get it. But what is going on? Because I would have thought with lower interest rates, we would have seen the higher sales, which we did. But you would think they're coming from the rental market. So who's replacing the first-time home buyers in the rental market? Who's coming in there?
Well, just as we talked about the demographics of the silver tsunami, there being this big bubble of older people that are going to add inventory into the marketplace in the future, I think the buyer, the new buyer, the first-time buyer, is a product of the demographics as much as it is economic vitality. Actually, more. There is this generation X, Y, Z, Z.25 or whatever, these multiple generations that were the byproducts of the baby boom, the tail end of the baby boom generation. My kids, that starts with a Generation X, but even moving down. My kids are in their 40s, so there are a bunch of kids that are coming along, 20s, 25, that heretofore demographically make up a big a new addition to the housing market. They weren't in the market for they were either staying in a dorm or they're staying at mama's. Now they're forming family units. They're going out and they're buying houses.
And I would add to that, it's not just
or they're renting.
Yeah, and it's not just the people in Lafayette. It's also this is just my hunch, and I think you've heard me say this before. It's also the people who are in Welch, graduating from high school. They're in Franklin, they're in Gaydon, they're in, all these places that they're not, those are younger people,
right.
Most likely not renting and staying in Jennings. And they're probably coming to Lafayette.
That's right.
And renting.
That's right. There are actually two sides to that coin. We're seeing people moving out of Lafayette Parish to buy housing. Yes. And we're seeing people who are outside of Lafayette Parish
coming to rent,
coming to rent or to work. Right. The hub city, and I think that's going to continue also. Yeah.
And then it'll just end up growing to the point where we start absorbing the towns like we did Youngsville and Broussard, and at some point we're going to be a much larger metropolitan area.
I would hope so.
So speaking about that, let's talk about commercial, because one thing that's not following the trends with the interest rates is commercially, and I know we don't have any data on that, but my feelings, and I don't know how much you've been following this, but I can tell you I've never seen the industrial sector, so low on supply. As far as especially in the lower price range, like 500 and under industrial buildings, it's almost non-existent. They have some big facilities, right, like multi-million-dollar facilities, which, are sitting. But what is going on? Why is there so little supply in the industrial and commercial space?
Well, in the industrial side, I guess you're talking metal buildings.
Metal buildings,
okay. I think that this is following a trend that's probably a decade long, that as the oil industry, which was the impetus for a lot of these metal buildings to ultimately be built. When oil was king in Lafayette, the service industry was based out of here, and for the Gulf, that you had this enormous supply that was built up over decades, and over the last decades was ultimately abandoned or right, or became vacant. And now it's slowly being absorbed by all alternatives, but there's been no product that's been added. And I think that ultimately that's what we're seeing. And there's nothing on the charts that would be the incentive for somebody to go out there and do a major development. Right. Okay.
Yeah. Very few industrial developments are going up. The cost just doesn't come close to what the market rate would be for rental or anything.
Absolutely.
So unless you're building something, the only people building industrial commercial spaces is people who are doing it for owner occupancy. Yeah, so they're not doing an industrial park anymore, which was common. I mean, the last one that was done was probably Hammy Davis's on off of Vera School Road. That development is probably the.
So yeah, I don't see a whole lot of future in the metal building. But again, what will be its salvation is that there's no inventory.
Right.
You know, so it's kind of like the residential. Yeah, we don't have a demand for it, but we don't have the inventory either. So
Right.
it's kind of imbalanced
Sure.
to a certain
It's
degree.
interesting, yeah.
And you know, as far as the other aspects of commercial, you already pointed out, one of the things about the commercial, when you talk in terms of the residential market, it's pretty much the residential market. When you talk in terms of the commercial market,
Office
you got
space,
office
retail,
space, retail,
restaurants,
all
you
that,
know,
all that.
industrial.
So it's
Yeah, but-
real
and
hard to quantify.
Well, speaking of that, I mean, office space has gotten a little bit of a pickup since 2019. It's more, but it's still it's very much still a tenant space.
Yeah.
You know, the tenants. You know, if you've got an older building in Lafayette, you need to make it happen for the tenants. You know, and you're not. You know, the prices haven't increased significantly, if any at all, in the last 2 years as far as price per square foot on an older building. However, the newer buildings are costing twice as much, and if you look around, there's like drive through some of the just the shopping centers. There's not a lot of vacancies in the shopping centers, and there are some really big developments coming online, like the Forum, and then you know where the Chimes is, and we're you know that's just to break even on most of these developments from a developer standpoint, you've got to charge $35 to $40 a square foot, which, you know, you could get something in, you know, the oil center for closer to $15 to $17 a square foot. So it's double. But I'm wondering what's driving that, because like we have not seen a slowdown in retail. We've really seen an increase. It seems like, at least at our office, more people opening up more businesses and doing business, and it doesn't look like the interest rates have impacted, you know, startups as much as it has with residential.
Well, I don't have hard numbers on that,
Yeah.
but you know, I share your gut feeling that you have. I share it. You know, it just
you can
seems
see
like
it. There's
the
not a lot of
dynamics. You know, the old economic gauge for Lafayette was go drive down Johnston Street. Okay, if you can get from one end of Johnson Street to the other in an hour, things are bad. If it takes you an hour, things are good.
Yeah.
You know, that's kind of what we're seeing is you go and look at the parking lots, roofs still full, restaurants are going crazy. Okay, people spend money here. It is the economic hub of a huge demographic area. When we talk in terms of Acadiana, we've got 500,000 people basically in Acadiana.
And even more coming here to eat, dine, go to the hospital. Like I know people they're coming from Alexandria.
Right.
Like people are in Alexandria, they come here to go eat, to go out, to enjoy themselves. So it is a big area. I mean, you're talking like Morgan City. People come here.
Now, one of the things I've been reading that kind of intrigues me, and I see that happening certainly more in urban areas, and that is the idea of reconstituting certain types of property, particularly commercial property, and for a major urban area where you may have office vacancies, they're talking about retrofitting office buildings and turning them into residential, lower priced residential, and maybe that is part of the solution to the long-term housing situation of affordable housing, not just housing, but affordable housing. And we're seeing in the distribution of what price points people are buying that although it's not a major factor in Lafayette, it's becoming more and more pronounced that in certain price ranges, you're having your inability to have inventory ultimately impacts your ability to have numbers of sales. And so there is a concern nationwide about the affordability of housing, especially if the cost of housing is rising through material cost and interest rate cost. And one of the ideas is taking some of this excess that we could have, even in malls. Like you go to the Acadiana Mall. I hadn't been to the Acadiana Mall in years, literally years. But from people that I talk to say, you know, it's just not as vibrant. That malls are not what people look for in retail anymore. So what are you going to do with something like that? Could it be retrofitted into something that might look like a small river ranch community? Yeah, good.
Maybe so.
And so there's a lot, that we can. All you need to have is an imagination and an economic plan that works. And hey, who knows what can happen?
Well, before we end, I want to get your prediction, because you got to predict. Last year, you predicted a 5% decline in sales.
I missed that.
Which you missed it by 10%, or no, by 7%, 8%.
Yeah,
And then you predicted a 8% decline in volume, 136 million, and you were dead on that.
Dead on.
So you're 100%. Well, you're 50% on your two predictions. Where do you see
I
us?
thought that there would be more of an impact on the average sales price being lower, and that was, I hit the dollar volume, but I thought it would have taken a lot more sales to do that, because I thought
You weren't expecting the average sales price to increase another 10%.
Absolutely,
Yeah.
absolutely. So yeah, what am I going to do when you're just dead spot on halfway?
Yeah.
What are you going to predict now?
Well, the volume's really the important part.
Well, here's what I said. I feel that home sales in 2023 are going to continue to fall. They're going to stay, but not by much. They're going to stay around the 2018, 2019 levels. And that is about 5,250 to 5,600 total sales.
Mm-hmm.
That would equate, depending upon whether you're low side or high side, another 13 to 20% decline from 2022. Dollar volume will be ahead of 2020. I estimate it'll be around 1.4 billion, which would be a roughly 12% decline from our 1.586 billion. So I still see the 2023 as being an adjustment year, but I do think after that it plateaus, and we kind of follow that trend for 3 to 4 years, waiting for the next big wave to catch on.
Awesome. I love the boldness of making these predictions, because I know a lot of people don't like to put their name on a prediction, but this is great. We're gonna we'll check back with you, see how right you were.
You got to have the courage of a 72-year-old to do it.
Well, I appreciate everything, and I appreciate the information. We went way over our time limit, and
that's what editors are for.
I feel like this was all very valuable information. I can't thank you enough again. I'm honored and grateful that you spend the time with us and consult with us on what's happening in the market. And I'm looking forward to our next show, which will be next quarter.
That's correct.
So, Mr. Bacque, thank you very much. Appreciate your time. All right, guys, thank you so much for watching. We really want to hear from everyone. So please send us your comments, your questions, or correct us if you see something different than what we're presenting on our show. Our goal is to keep this conversation going, and we want to learn more about what you guys really want to hear about. So let us know if you want to hear more about investing in real estate, the home buying or selling process, or anything else regarding real estate. So please like, share, and subscribe to our channel, and we'll continue to bring you more real talk. I'm Jim Keaty, and thank you for tuning in.